Okay, so we are on another session today, and we're going to be diving into this is the section that we're going to be talking about specifically as it pertains to loan program education. And this is really important because as you go through the process and deal with clients in the commercial real estate world, you need to understand what are the different programs that are available to them that you can understand the different mechanisms by which you can walk through and explain it. So I know that you've gone through the 504, the 70 program, Freddie Mac. So I just want to do a quick broad brush with you and see what do you remember about any of these.
Yeah,
Remember about the 504, the 7A, Freddie Mac, and then I can help kind of backfill anything, and then we'll just kind of pick up on Life Company and Cmbs.
yeah. So the main difference between the 7A and the 504 is that the 504 is really more focused on real estate loans, anything to do with buying property, buying property. I guess there's no other word for that. Then the 7A is more like business acquisitions if somebody's looking to take over a business, that kind of stuff. So that's really the two main differences, and that's the main thing that I remember. I have a list of notes, but that's the overview, basically.
Yeah. So basically, when you deal with the 504, it is just real estate. It's typically always been just purchase, but they recently started to do refinances. And 7A does do real estate, but 7A will allow you to do other things. Okay. So, like purchasing a business. So, if somebody comes in and they say, hey, I'm buying a partner out. So, Will Farrar and Dave Cotter have a business together and we built it up. And now we say, hey, I want to get out of this. And Will says, well, I want to own it. And so he says, I'll buy you out, Dave. Then where do you go? Well, you can't go to the 504, so you go to the 7A. And the 7A, remember, is both of them are government programs. Okay, so these are federally mandated programs that have been issued by the government with the intention in mind to prop up small businesses. Because if you think about it, the small businesses are the one who keeps the government up because they're pumping all of this commerce. Henceforth, what do you think comes out of all the revenue they make that benefits the government?
Taxes.
Taxes, right? So they're creating what? What do they create?
What do taxes create?
Well, no, but like what do the businesses create?
Um, I mean, depending on what they do, but I mean, they're creating revenue for the government.
So they're creating revenue, but they're also creating jobs,
Yeah.
right? So they're a job creator, right? Which also provides income for the individual. And then that individual has to pay taxes, right? So all around, they want to infuse life and to the small business community with the intention in mind that this can then turn around and produce revenue and jobs for other people. Okay. So that's why they will focus on, special classes, so minorities, women business owned, et cetera, right? They will sort of try to help protected classes is one of the criterion that they try to look in. They try to look in areas that might be a lower income areas to try to approve the loans. So they're trying to sort of, level the playing field on that. The programs themselves, the government doesn't actually issue the money. Okay. Who does?
Um, not the government. I don't know.
The bank.
The bank, yeah.
The bank is the one issuing the funds, and the government is giving them an insurance policy.
Mhm.
Do you know what I mean by that?
Yes, I'm pretty sure.
What does that mean?
So they're offering them an insurance policy, as in, I mean, I guess I don't know really how to explain it. So I guess if you could, I'm sorry.
It's okay. Don't worry about it. This is why I'm kind of testing you just to see so we can walk through it.
Mhm.
So if I provide you an insurance policy, um, what is that insurance policy for
Um,
in any situation?
Accidentals, if something happens,
Yeah,
kind of to cover your behind.
exactly. It's risk, right?
Mhm.
If you got health insurance, you're buying it if you get unhealthy, right? If you have insurance on your car, it's if you get in a car accident, right? If you insurance on the house, you're getting it if the house burns down, right? So there's all these reasons why, and then the government provides insurance to the bank to say you lend the money and we will give you a guarantee that if this person defaults, as long as you stayed within compliance, we will give you the insurance and we'll give you 75% of the loan amount. So if they lent you $1 million, the government guarantees they'll give you 750,000
Mhm.
if they default and if they can't collect the money, right? They can go back to the government and say, pay up. So that gives the bank a lot of comfort, right? Because they're like, good, we got some backstop. And so a lot of loans get done that probably otherwise wouldn't get done if the government didn't do that. Okay.
Okay.
Like startups and things like that.
That makes sense now. I got it.
Okay. Does that make sense?
Yes, sir.
Okay. The other thing is that the 504 has a certain structure, meaning they have certain terms. Do you remember what some of those were?
Yes. Let me look at these again. Um, so one of the things that I have here is that it's usually a blended rate. The bank will do 50% of the first mortgage, then apparently there's a second mortgage that comes in too, and that's 40%. That means that it's basically a 90% LTV. So the borrower would have to put up 10% on his own. I do want to ask you again, just to clarify where that extra 40% comes from. In my notes, it says it's a second mortgage, but that's probably not the right way to describe it.
No, that's correct. That's
Yeah.
accurate.
Mhm.
It is a second. It's a first by the bank. Okay. And then the second comes on top of it, and that is by the CDC.
Mhm.
So the CDC is the Certified Development Corporation, which is a nonprofit organization designed to issue these loans with the intention of creating jobs. Okay. So they're just trying to make sure it fits all the criterion and the box, so to speak, and then they will go ahead and issue the funds. And again, they issue the money, and then actually they never really issue the money. The money gets issued, and then it gets sold off, right, into the secondary market. And so they just kind of act as this intermediary and make fees from doing the underwriting. Okay.
Okay.
So that's their job, is to do these things. So they will provide, the first is usually 20 to 25-year amortization, and it's fixed for 5, 7, or 10 years. And you go, well, what's the rate? Well, it depends. It's whatever the market is. And then the 504 CDC will provide 40, and their term is 20 to 25 years fixed for the whole time. And then they will fix the rate. Okay. So they've so that's kind of the deal there. And those rates are registered daily, okay, online, and I'll just show you so you can see it. You see that?
Yes.
So you'd see today in July, 25-year fixed, 5.107. Look at what it was in 2021.
Wow.
Pretty big difference, huh?
That is a big difference.
2020. All right, look what it was in 2019. So dramatic change.
Mm-hmm.
So those are published daily, or I should say monthly, but you know, they will tell you kind of what it is, and then you know what your rate is. And those two are blended. You have two payments, two lenders. If you're doing construction, the CDC does not provide construction financing. The lender funds the whole thing, and they do their own first and second. And when the construction is complete at C of O, they will take that loan out in the second with their loan once they have completion of construction. Okay.
Yeah.
It is owner occupied only. You cannot do this for an investor property. And it is, you have to occupy 51% of the space. If it's new construction, it's got to be 60% of the space. And these are good programs, okay, because you've got long-term fixed rates. And they usually take about 90 days to close. Okay. So that's the 504. 7A, government guaranteed, backed by the government. Bank funds the whole thing. It's a 25-year amortization, and the bank has the choice. They could float it, which a lot of banks do. They cannot go more than prime plus 2 3/4. That's the max they can charge. And if you remember, let me see if I can pull it up for you. Prime. See if I have. Prime rate is, here we go, are we ready?
Yes.
So 5.5%. Okay, so that's the rate plus whatever they charge. 2.75, right? So it can get expensive. So they, and there is a 5-3-1 prepayment penalty. Do you know what I mean by that?
I do not know I have written down here that they're, I have something written down about prepayment penalty, but I don't know what 531 is.
So it's 5% for the first year, if you pay it off. It's 3% for the second year, if you pay it off. And it's 1% in the third year if you pay it off.
Okay. So
if the client pays it off, that's the penalty that they're going to pay. Okay. And then the fees the client's going to pay, and they'll go up to 90%. Some lenders will do 100, but the fees they're going to pay is usually about 3 to 3.5% of 75% of the loan amount. Okay.
Okay.
Make sense?
Yes. Obviously these are small business loans, but at what point is it too big, if that makes any sense, if you understand what I'm trying to ask?
Yeah,
Obviously,
it's too big if it exceeds $5 million,
okay,
because the cap you can borrow for one borrower is $5 million. There's some minor exceptions for that, but it's pretty much the case. So it's really only for someone who's doing one or two buildings ish, give or take. But you also become too big if you have too big of a liquidity. So if you have millions and millions of dollars in cash, you're not going to qualify. And if you have too big of a net worth, you're not going to qualify. Because they just figure if you have that much cash, you shouldn't be getting this kind of loan.
Yeah.
That's their attitude.
That makes sense.
So they're trying to help the person that sort of needs it. So.
Okay.
So those are kind of those programs. Okay. That's how a lot of loans get done. These loans, they are a pain in the butt. I'll just say that right now. A lot of paperwork. It's minutia. It's the government. What do you expect?
Yeah.
But you know, they serve a purpose at the end of the day. Okay. So what do you remember about Freddie Mac, the Freddie Mac program?
Yeah. Freddie Mac and Fannie Mae, or specifically?
Yeah, it could be both. Yeah.
Yeah. So really, with these two loan programs, they look for multifamily properties, usually 5 units or more. They can obviously look at other asset types, but really their whole goal is to provide affordable housing. And the main difference between Freddie Mac and Fannie Mae is that Freddie Mac, they kind of keep control, keep everything in house throughout the whole loan process, while Fannie Mae, they kind of open it up. I forget the proper term, but it's delegated underwriting. I'm pretty sure that's it. They kind of have somebody else underwrite the borrower, while Freddie Mac kind of keeps it in-house. Another thing that I have written down here is that in order to qualify, they don't do construction loans, and they have to have 90% occupancy in order to qualify. But once, if somebody is looking to qualify for a construction loan after they finish construction with their previous loan, they can then transfer over to one of these loans. I know I just said a whole lot right there. I'm just spitting everything out that I remember.
No, it's okay. It's good. Yeah, you're right. It's multifamily. It's apartments pretty much, right? You could have senior housing, mobile home parks. So it's beds, right? I mean, that's kind of what it's for. Anything housing oriented. And it is again to advance. It's a government program. It's to advance the initiative of housing. They do all sorts of nuances for low income housing and tax credits and all sorts of stuff, right? It's again no construction, 30-year amortization, and it's fixed for 5, 7, or 10 years typically. Rates again are going to be whatever market is, and it's non-recourse. Do you remember what non-recourse means?
Yes. So they're not going to pursue you if you don't make the payments, if you go into default.
Except for if you
Fraud and
right, negligence, dumping chemicals, pretty extreme things.
Yep.
So, and close in 45 to 60 days, so pretty quick. They are probably do the most apartment lending of any lender, just because the rates are the most competitive. And they usually get the max proceeds. So they're hard to beat. I mean, most people can't compete with them, unless there's some sort of quirk that just makes it so they don't fit. There is some trickiness to them. If you've never borrowed from them before, it gets a little tricky. It's a little bit of the chicken and the egg. It's kind of like, well, how am I supposed to, get a loan from you if I've never borrowed from you and I've never borrowed, it's just kind of like, but you can get over that if you have certain net worth, or there's some other elements, but the first one's always the toughest. Usually you're going to spend about 12 to 13,000 in fees, and they're great programs. They can do interest only, for that period of time. So they can do 5 years interest only. Do you know what I mean when I say interest only?
Yeah, I feel like it's pretty self-explanatory. Meaning that you don't have to actually, I could be completely wrong, but you don't have to actually make the payments on it. You just pay the interest that you would pay on the loan.
Yep. Which makes your cash flow better because you're not paying the principal down, right? You're just paying the interest. The downside is you're not paying the principal down, right? But you're not having to make principal and interest payments.
Yeah.
So the cash flow is certainly better and you get more cash in your pocket.
And is that usually pretty attractive to the majority of people?
Yes.
Yeah.
Yeah, because again, if you think about it, you're like, well, if I'm not going to own this for a long time, who cares? I'm going to collect as much cash as I can, sell it, and somebody else can, make the payments, right? So it's pretty attractive to people to go through that for sure. Yeah. So it's a good program. They'll go up to I think it's 7 or 7.5 million on Freddie. Then they cap out. Fannie goes up to, hundreds of millions of dollars. So they're great programs. So yeah, I just wanted to do a quick overview of those. Life insurance companies. What do you remember about life companies? Anything?
I'm gonna flip on my page real quick. Yeah, so life companies are very conservative. Usually life companies get about 80% of, they take 80% of their, I guess, revenue and put it into government bonds. So obviously they need to make up for the other 20%. What are they going to do with that? And that's whenever they get into commercial mortgages. Like I said, they're very conservative. So they really only will accept certain loans, give out certain loans. And I remember they're in contract with other companies. I forget what they're called, but the two people in the video, they worked for that one company, correspondents. And the correspondence job is basically to go out and find different kinds of loans for the life companies. The life companies will send the correspondents kind of what they're looking for. And basically they'll go out and use their connections and try to find a loan that would please the life companies.
Yeah, correct. So you are correct. So conservative, have to invest the money. They use correspondents, which are third parties kind of administrating loans. They're the ones that are going to go out and do all the, underwriting, servicing, exactly what you said. They're going to package the loan up, send it up to them, and then the life company is going to actually approve it or not. And then they'll close it, right? They'll go through the closing process. And then ultimately it'll be taken over by the actual servicer. And then, life and companies, again, they'll go 60 to 65% loan to value. Do you remember the 4 food groups?
Yes, apartments, industrial, office, and retail.
Yep. Spot on. Good job. And then do they do recourse or non-recourse?
I think typically it's non-recourse.
Yeah, they can do both. And it just depends. But I would say most of the times, if it's larger, they'll do non-recourse. but a lot of times they'll just, if they're smaller, they might ask for recourse.
Yeah.
It's a little bit more expensive with your cost, but your rate's always going to typically be better. But right now, the rates for bonds are so high that, honestly, the rates aren't that good. They're in the fives, the sixes, so they're not that attractive. Okay. But they're really great to work with. Once you get a loan done with a life company, they're just smooth. You don't ever wonder, things don't change. It's just, they're fantastic. So they're pretty clean to work with, at the end of the day. But they are conservative. They really, only do income producing properties. Some of them very rarely will do construction. I'm doing one right now for 65 million in Texas. That's construction with the life co. So that's kind of the life company, structure. They're going to underwrite to cash flow, historic and or in place at a 125 to 135. They are conservative, so they're going to add a vacancy factor. They're going to add additional reserves to the expenses, which you're going to learn about in the underwriting phase. But they're definitely a good option for an income producing property. Okay. So it's something that you just need to be aware of. And they do I would say a significant amount of the loans. In fact, I'm trying to think if I have a quarterly origination numbers. Try to see if I can pull up like a little chart. It's not gonna. See if we quarterlies. Sorry, I'm just pulling up the. Let's see. Yeah. It's a really good publication. Here we go. In luck. Okay. Let's see. So this will give you a really good idea. All right. See that?
Yes.
So look here. Life insurance companies did 580 million, right? Q4 2020 in originations. Okay. So look what percentage of the whole sector. Look at the agency. Remember we just talked about Fannie, Freddie?
Mhm.
Look how much of the whole industry they do.
Wow.
44%. Okay, that's crazy.
Mhm.
And then banks do what? Almost 30.
Okay.
Cmbs, 14. And then look, just everybody else, right? REITs, state, local government, but pretty much the predominance is right here, right? Those food groups we're talking about. So just, and just to give you an idea, this tells you the debt outstanding. Look at the debt outstanding. Just for that quarter, 837 billion, right? So you just, these are big numbers.
Yeah.
getting into big numbers, you know. So again, it's an industry that is very massive, and it's all encompassing. Just look at that, just a tremendous, look at the distinction there, the banks. 1.4, guess that'd be trillion, okay? $1.4 trillion outstanding. So a lot of debt. Now, what's interesting about this is these two are pretty much government agencies. So kind of crazy. Pretty much.
The first one that you showed me, which showed the percentages, why are agencies so much higher than all of the other industries?
Well, you know, it's because multifamily apartments are probably one of the most sought after commercial real estate types of properties from everybody. And that's why it's just such a high volume. There's just so many people want to buy it. I mean, if you go online and just type in, you know, buying apartment complexes, I mean, there's just tons of data, tons of education, because so many people want to do it. You know, they want to own apartments. And you ask yourself, why would somebody want to do that? Well, number one, it's, you know, consistent cash flow. And when the market goes kerplunk, you know, people still have to rent, right? Like they still need a home. You know, if I'm in an office complex and I go, well, you know, I can downsize, or I don't even really be in here, or whatever, right? But for an apartment complex, stay pretty steady, right? And so people like that consistency of cash flow is a lot of the reasons why. But people just love apartments because, again, it's consistent. It's been around since biblical times. I mean, people are always renting, you know, I mean, it's been around. I mean, this is not like a fad. We're going to wake up and go, oh crap, Amazon just came in, like they're going to take out apartments. It's like, well, no, they're not. You know, technology doesn't affect apartments. You still need to lease a place, you know. Now there might be other factors that threaten it, like single family build for rent. But you know, at the end of the day, it's pretty consistent. Okay.
Yeah.
That's why people like them.
Okay.
Good question. So the Cmbs loans, let's kind of dive into that, and we'll just land the plane on that one.
Yeah. So overview of Cnbs loans. First of all, the Cnbs lenders will finance a property, give the initial loan out, and then they'll kind of tranche or put all these loans together and create a bond offering, which they will then sell to other investors. So it kind of gets the risk off of the Cnbs lenders onto other people, and then they make that whatever the difference is between the original loan and then selling the all the loans put together. Specific loan terms, I'm not 100% sure on that. I tried to find my notes from the first time we covered it, and I couldn't find them. I tried to do some research, but if you could go over some of the specific loans.
Yeah, it's a 30-year amortization, and it is fixed for 10 years, 7 or 10 years. It's non-recourse, always, never not non-recourse. They'll take on more risk, and they underwrite with more reserves. Okay, so what they'll do is they'll look at a retail center and they'll say, okay, well, you got an anchor tenant in there that takes 40% of the space. Their lease comes up in 7 years. Okay, so we're going to impound every month $25,000 from the payment. That'll go on top of the payment, and it's sweeping this cash into a reserve account so that if that tenant leaves, we have forced you to save money to replace that. Okay, so they'll do a lot of those things to kind of mitigate risk. So they're very reserve heavy. A lot of people don't like that. and they're just super nuanced because it is a bond offering and there's just a lot of paperwork. So they're having to get a lot of minutia. And the problem with them, which I don't like them that much, is because it could just change at the end. Okay. And all of a sudden the rate changes and you're like, holy crap, all this stuff just changes on a dime. Okay. And your rate can change at the end, and all of a sudden everybody's just kind of stuck because all of a sudden the market goes crazy and the bond comes back and says, hey, we know we quoted you at this spread, but the market won't accept it. They'll only accept this spread. So you're kind of like, take it or leave it, right? And you're kind of in a bit of a pickle because you spent all this time and energy and you're running out of time, and you kind of go, well, crap, what am I going to do? So that's the risk, with these kinds of loans, is that they could change the terms at the end. They will do interest only. They'll go up to 10 years in many instances. And they'll go up to 80%. I mean, they go to high leverage. When the market gets funky, they'll either shut down or they'll just be super conservative. Because remember, they're asset driven. Okay.
Yeah. Okay. That makes sense.
So, and they usually are doing larger deals. They typically are not going to want to touch anything under $5 million. Some of them won't even touch anything under 20. It's not worth the time and the cost because they're expensive. You'll spend 50 grand on just legal fees and stuff like that just to do the loan. So makes you want to be an attorney. Right?
Yeah.
So that's the kind of deal. Again, 4 food groups: office, retail, industrial, multifamily. They will do self-storage as well. This kind of falls under industrial, but those are the kinds of loans that they'll do, and it is good for you to understand that because, again, like you saw, they take about 12 to 14% of the market share. I've done many of them. I don't hate them, but I'm not a huge fan. But I just do a lot of disclosures up front. I mean, I just tell the client, I'm like, look, so what's going to happen? It's probably going to change somehow. So are you going to freak out when I call you up and say the spread changed? And if the answer is yes, then we probably shouldn't do it because it's volatile. It's so tied to the stock market and bond market. If you have another COVID or, all of a sudden you get bad news, I mean, it's finicky. So they serve their purpose. They do kind of outside of the box deals with a little bit more hair on them, but they serve their purpose. And they securitize things. But again, they're sort of a big broker. They're just kind of delivering news. They're like, hey, the guys aren't going to buy our stuff. So, and we're not going to close your loan unless they'll buy it. Because I'm not going to get stuck with, $500 million of loans on my balance sheet that I can't sell. Right. So it's just kind of big boy stuff. It's just, they're kind of like, take it or leave it. I don't really care. Where if you talk to a bank, there might be a little bit more relationality to it. But I remember when the market crashed and, some of my commitments that they issued were totally gone. I mean, they called me up and said, hey, sorry, man, I'm not doing the loan. And I'm like, no, you don't understand. You issued a commitment letter. They said, I don't care.
Yeah.
You can't do it. We're out. We're completely out. And I'm like, what? So those were some rough conversations.
Yeah, I can only imagine.
Yeah. So again, really, we try not to do them if we don't have to. But they are there, and we have. And I just did a few last year for a client that had to go that direction, and I told them very much in advance. Stuff still happened. He still got ticked off. And he said, I told you, man. I said, this was going to happen. I mean, I don't know what else to do. Wasn't rude about it, but, we just kind of walked through it and said, he finally calmed down, but I just said, it's not fun. It's just, this is the nature of the finicky beast up front. So those are kind of some of the programs. What's going to happen next or Thursday, and I think I have to go to an event. So Tom's going to take over, but he's going to walk you guys through hard money, soft money loans, bridge lenders, and then it'll kind of get you guys into the 4 scenarios, which is the small business auto, retail investment purchase, subdivision home building, and then the scenario. So it'll allow you to give a project that you get to walk through. So it'll put some feet to it, so you're gonna start getting your hands dirty. Okay. So that's all we've got for today. And so do you have any questions